Talked about it last week, guys. Regional banks, biotechnology in general, both of these things were struggling. There are large cap biotech stocks, but most of these biotech stocks are very little, $1 billion, under $1 billion. Most of them are under 10 billion. You would be surprised to hear that between 10 billion market cap and 30 billion market cap for biotech, there's like 3 companies. They just don't exist because they either go to zero because their drugs don't work and they don't save anybody's lives, or they get bought out by the big guys, right? So there's very little in between. So I think it's important to understand like what biotechs even are. You got the big ones and you got a zillion little ones. And the zillion little ones are filtered throughout the Russell 2000. There's like 240 of them in the Russell 2000 because the small cap S&P 600 index requires a track record of earnings in order to be included. The Russell 2000 does not. It's just a market cap thing. So you got a ton of biotechs. Biotechs are not in favor, or regional banks are not in favor. Those small cap indexes are going to do very poorly, right? Small cap industrials are up 75% this bull market, right? Biotechs and regional banks have not done those. So when you talk about small caps, you also need to be careful. But to biotech specifically, it's all, to me, it's the interest rate story. You had some of these big names working already, some of these drug manufacturers working already, and now you're getting that bid in small caps at the index level with regional banks, biotechnology stocks, they're all moving together. So it's all that rotation coming in. So I think it's a bond thing if you really want my opinion.
Okay, so it's a bond thing, but the market may have solved the problem that BC wasn't, meaning you're right. Small cap 2000 is market cap weighted. You're saying the small cap 600 is profit based. I'd be interested to see how they've performed over the last couple of years.
They look exactly the same.
Why do they look exactly the same? Because of interest rate?
Because it's an asset allocation. It's an asset manager, portfolio manager allocation correlation versus a fundamentally oriented. They move together.
Shouldn't that diverge if profits matter?
You would think so. The answer is no. They don't. I will say, though, when you zoom out, the S&P 600 is slightly stronger, not by much. If the market were to close today, it would be the highest monthly close in the history of the small cap index. I'd buy the Russell 2000 because it's more liquid. The options are more liquid. Like the S&P 600 ETF isn't as liquid.
So you choose the liquid. Okay. The other thing that may be in favor of biotech is to jump the shark, like Merck, Lilly, Novo Nordisk, Amgen, Regeneron. Now they have market caps that may allow them to do some hunting. How does that work? It feels to me, this just goes to a question we should help, because you have the expertise here queued up to get us back on track. But if you have the expertise here, it always seemed to me companies should be buying when things are broken, but they don't want to buy things until their stock is a higher price, right? They'd rather overpay for, it just makes no sense to me. So now that Lilly and Novo Nordisk and Amgen is in their head, and Intuitive Surgical and Regeneron and all these companies that are like the famous biotechs, do they feel better now about going out to buy versus, buying beaten down biotechs?
When it's a strategic big pharma, generally speaking, the price levels in terms of up and down, etc., that's icing on the cake. They're absolutely picking it. Biotech is a well-orchestrated machine in terms of startups to growth to then selling to one of the big pharmas, etc. There is a timing sequence that's basically been relatively consistent with market volatility over the last 20 plus years. The fundamental drivers, since we talk about AI a lot, AI is again early days, but in the next 3 years, because of the fundamental way AI is going to open up the aperture for discovery on compounds and proteins and so on, testing a lot of things through AI, especially through examples of Google's DeepMind with AlphaGo and so on. And they've put out there in open source this incredible 12 million protein database. It's a total game changer for the way the biotech industry and the pharma industry operates. But it's early days, so don't go rush out into any of this. But in the next 2 to 3 years, we are going to see a fundamental change potentially where there's more drugs going through the regulatory approval cycles, which may affect how pharmas that you're asking about, Howard, when they come in and jump in. Obviously, if we have a correction down, etc., if the strategics and investors are looking for a time to bottom tick some of this, that'll absolutely happen. But I just want to say, generally speaking, there is a timetable on getting the FDA clearances and when pharma comes in for the first leg and the second leg and partnerships and JVs and so on. So there is a methodology to the volatility.
I'm happy for the people that are benefiting this. It's just very hard as a 60-year-old to now want to go learn something about this industry. So I'm going to have to do the indexes.
And a follow-up to Thelonious Stank's chart there with biotech breaking the downtrend relative to the Qs. Is some of this just a rotation out of Qs, out of tech? And I'm looking at your advanced decline and I'm looking at your equal weighted charts. Just tell us about that one. This chart is just incredible, given that what's been the strongest area of the market is now pulling back and NVIDIA's kind of getting a little wonky and so forth.
Yep, you could throw up the advanced decline line here on the New York Stock Exchange, making new all-time highs, right? So the New York Stock Exchange consists of the most important companies in the world. So all of these ADRs that the most important companies in individual countries in Europe and Asia and Latin America, they trade on the New York Stock Exchange, right? So when you take the advancers minus the decliners and you add those, you could really see the trend of the actual components of the world's most important index, which is the New York Stock Exchange, the world's most important exchange, I should say. So the components, so this is common stocks only. So this excludes like closed-end funds and like other things that trade on the New York Stock Exchange that are not stocks. So this is very stock specific, making new all-time highs. So let's understand that everybody was complaining that it was only 7 stocks working, even though it wasn't. But that was the complaint. Now that those 7 stocks are not working and everything else is, they're complaining about that, right? It's just that people like to complain. The idea is to understand that in the month of July, you had all-time highs in the Dow Jones Industrial Average, S&P 500, NASDAQ. You had the highest number of stocks on the New York Stock Exchange above their 200-day moving average this entire bull market, right? So in other words, if you're above the 200-day moving average, you're probably not in a downtrend. There's nothing magical about 200. It could be 205 or 197. It's just, that's a pretty good gauge, right? It's about almost a full year. And if you're above that, you're probably not in a downtrend. We saw the most amount of those stocks that we've seen in years, this entire bull market. You also had the most amount of new 52-week highs. So the amount of stocks making new one-year highs on the New York Stock Exchange was the highest number of this bull market. It was also the highest number in the NASDAQ this bull market, right? So when you talk about market breadth, like things keep getting better. Before market tops, you see things getting worse. That the opposite is happening, right? Things continue to improve. And I'll point you to the breadth is historically very extreme when the worst S&P sector is up 15%. Right now, the worst S&P sector is up 6% in a year-over-year basis, right? So we're nowhere near that end either. And then you also tend to see the causes of that downtrend, the leadership groups to the downside already rolling over, making new lows, down 15, 20% already before the S&P 500 peaks. None of that is happening, right? So things continue to improve. You know, as Howard always says, the news keeps getting worse. You know, the noise keeps getting more abundant. To me, that further reiterates it's not the noise or the news. It's filter failure. If you are looking at what the market is actually doing versus all this other nonsense, you're going to be a huge advantage over those who are forced to consume the nonsense and ignore what's actually happening.